Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, everyone, welcome back to yet another episode. It feels like we haven't done one of these in a while. Hamish, what's going on?
Yeah, I'm going well. Yeah, I was just thinking that we've done 2 episodes now back to back that I think we just put out. We recorded them, I think maybe about a month ago or so in Melbourne. Yep. So yeah, we've put a couple of pre-recorded episodes out recently. So it feels like we haven't done one of these in a while. But yeah, how have you been going?
Yeah, I've been going well. Yeah, I feel like I'm out of podcast form, so I have to get back into it. But actually, people really liked the episode last week that we filmed when we were down in Melbourne, where we were talking about whether you or how to invest in an overvalued market. So I'm glad people enjoyed that. We'll have to do more of that. I like the idea of just maybe not. I like talking about the news, but maybe just every now and again picking a couple of relevant questions or topics to the current market conditions, just sitting down, just having a chat about it. I quite like that, especially when we're in person, because it just flows so nicely.
Yeah, I think those kinds of episodes are a lot easier. At least for me, they're a lot easier to do in person rather than, I guess, kind of doing it the way that we do this. It just feels like it's I don't know. It's like it's more of a natural conversation, and I think more. I don't know. It's like your brain works a little bit better when you're in person, like having a one-on-one, face-to-face conversation than over Zoom. I don't know if other people kind of experience that as well, but yeah, we'll have to do some more episodes like that. I watched that episode back, and I think it actually came out quite good. So if anyone hasn't seen that episode going through kind of the state of the market and value investing and index fund investing, then yeah, make sure you go check that episode out.
Yeah, it's a good one. But with that said, Hamish, we've got one very big news story to talk about this week. If you haven't heard enough macroeconomic chatter from us, well, this is the episode for you. Because as I'm sure you guys are well aware, the Federal Reserve decided to cut interest rates yesterday or the day before, as we're recording. So that will be the headline news story of the week. We're going to chat quite a bit about that and what it means. I'm also going to just chat a little bit about Starlink, because they are partnering with a major US airline, which is quite exciting. Hopefully we can get some better Wi-Fi on planes. That would be nice. And then what are you talking about at the end?
Well, I thought because we didn't have enough macroeconomics in this episode, I thought we had to put another macroeconomic story in. So I'm going to talk about Australia's economy and what's going on with the latest GDP data that was recently released.
Nice. All right. Well, should we get stuck into it then?
Yeah. With that said, today's episode is brought to you by Seeking Alpha, your one-stop shop for stock analysis, market data, and news. Access expert analysis and news for thousands of stocks. View buy, hold, and sell ratings from members, Wall Street analysts, and Seeking Alpha's own algorithm. Screen for stocks using a variety of fundamental and technical analysis metrics. Access 10 years of financial data and company filings, and manage your portfolio by tracking your investments with price alerts so you never miss a buying opportunity again. Click the link in the episode description or head directly to seekingalpha.me/young investors to try Seeking Alpha free for 7 days. Do you want to let's take it away and break down exactly what happened with this Fed rate decision, which, as you said, came out last night for us recording this?
Yeah, exactly right. Well, we have heard for quite a while there's been hypotheses saying that people believe that the time has come and the Fed will start to lower rates. They're going to change their monetary policy. Instead of raising rates to try and tackle inflation, inflation has cooled to a point where they say, okay, we're happy to start to lower rates from a restrictive level, which is kind of what we're at now to maybe more of a neutral level. I don't think we're going back to the low interest rate environment, which we saw for much of the last couple of decades, but something a little bit more neutral. And that is, we did kind of get confirmation that the Federal Reserve was going to start doing that by Jerome Powell's speech in Jackson Hole a couple of weeks ago, where he said the time has now come to switch monetary policy. He didn't lock in that he was going to take any particular course of action, but he did definitely say that it was time to change the trajectory of monetary policy. And yeah, last night we got the news from the Federal Reserve September meeting that they indeed are going to start lowering interest rates in the US, and they decided to cut rates by half a percentage point, 0.5%, which I think a lot of people in the space were just expecting a 0.25% rate cut, because that's kind of the increments that they were raising rates by 0.25% at a time. And thus this is being labelled as a big rate cut by the Fed, 0.5%. Yeah. So this means that the Federal Reserve, the Fed funds rate now rests between 4.75 to 5%.
Yeah, that would have. I just thought that would have been quite funny if 2 weeks ago at that conference he was like, "It's time for a policy change," and then last night he comes out and raises rates or something. Gotcha.
Yeah, we got him.
No, I think there was kind of a debate. The markets kind of seem to be tossing up between 25 basis points, 50 basis points. Some were even suggesting 75 basis points, but that's a pretty rare rate cut. Actually, I was looking back at all of the different rate decisions, and I can't recall a time where there was a 75 basis point rate cut at a single meeting. Maybe right. COVID, but even during the global financial crisis, it was in 0.5% increments, 50 basis point increments. So,
right.
I think 75 basis points, given that we're not in a recession, at least as far as we're aware right now, would have been a little bit crazy, I think. But yeah, I was still moderately surprised to see that he cut 50 basis points. Clearly, I think it may not clearly, but maybe it indicates that now he is somewhat concerned about the pace of things slowing, to give a little bit of a stimulative boost to the economy.
Interestingly, though, he's not really committing to an idea that, okay, we're now in a reversal of monetary policy. He doesn't want to quite commit himself to saying, oh, rates are going down, 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 down. Here it is at the press conference. Chair Jerome Powell called the rate reduction a recalibration of central bank policy, but he did note that the Fed will continue to make decisions just meeting by meeting. So he definitely he didn't commit to anything beyond the 0.5% rate cut that we saw. But next, I wanted to talk about why this has happened, and it's actually quite interesting because the Fed has a dual mandate. They've got two jobs. One is to promote maximum employment in the US economy, and the other is to try and ensure price stability, which is talking about inflation, essentially. And for the longest time, the last couple of years, we have just not been paying attention at all to the labor market, unemployment, because it just hasn't been an issue. It's been very, very resilient, surprisingly hot, too hot, as Jerome would say. But the thing that we have been very concerned about is inflation. And now what we're seeing is, and the Federal Reserve notes, is inflation has cooled, and they're very satisfied with the extent to which it has cooled. They actually noted, Jerome Powell said that the Fed's inflation number has cooled to 2.2%, but I'm not 100% sure what that statistic is. He said 2.2%, which is very low. I know that they track PCE as opposed to CPI, but even the PCE I looked at, and it's still at 2.5%. So I'm not exactly sure on that one, but nonetheless, Jerome Powell is saying, look, inflation has cooled. But what we've seen in the last month or two is actually, for the first time in forever, the Fed has started to raise concern about the other side, or the other mandate they have, which is maximum employment. Now, the unemployment rate is still very, very low, but it has been ticking up quite like a decent amount over the last couple of months. It's now up to 4.2%. Again, nothing to worry about, but it is ticking up. And they also note, Jerome Powell said, payroll job gains have cooled to just 116,000 per month over the past 3 months, which is quite substantially lower than what it was earlier in the year. So the reason why we're kind of here is because inflation, the Fed is saying that inflation has cooled and they believe that it is at a low enough level. However, the labour market side is worsening at the current time. So they come in with this rate cut to try and fix that side of the equation.
Yeah, it's the impossible task of kind of balancing, this impossible or near impossible balancing act that the Fed is trying to handle. So interesting to kind of see things kind of shift towards the other direction.
Based on what each FOMC participant estimates, it is expected that the federal funds rate will hit roughly 4.4% at the end of this year and 3.4% at the end of 2025, which is quite interesting. But one thing that I actually made a video on this recently, but one thing that I definitely want to highlight is that I've heard a lot of people, even my friends, and I spoke about this in my video, saying, oh, it's so good, rates are, they've gone up because inflation went up, but now that inflation has come back down, rates are going back to where they were. Oh, thank goodness we're going back down to 0 to 2%, my mortgages are going to get a lot cheaper. I have said that I don't believe that's going to happen. And it also, Jerome Powell is now also saying that he does not expect this to occur either. He says, quote, intuitively, most, or many people anyway, would say we are probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. He said also, quote, my own sense is that we are not going back to that. He feels as though, and he said this as well at various points in various little snippets here and there over the past couple of months, that he doesn't want to go back to that low interest rate environment. He thinks that it's fair that they lower the interest rates a little bit, but not too much, so that it's a fairly neutral position, and that gives them the opportunity to. If inflation comes back, they can raise rates by a little bit and probably get the same effect of cooling inflation. Or if the labour market really weakens, then they've still got the room to lower rates to stimulate the economy. So I think they're targeting that neutral zone. I don't think they're trying to pump the market or anything like that by lowering rates a great deal.
Yeah, I definitely agree with that. You don't. It might seem wrong, but basically, if the economy is doing reasonably well, then you kind of want rates as high as you can while maintaining that growing economy, so that as you said, if there is an economic shock or some event that comes out of left field, which does happen from time to time, then as you said, they have. The higher the rates are, the more room they have to lower them, and the more room they have to create that stimulative effect for businesses and households and the government.
Yeah, you're exactly right, Hamish. He's keeping that ammunition for a rainy day. Yes, I kind of alluded to this earlier, but he also did not confirm future rate cuts. Jerome spoke a lot about making decisions from meeting to meeting as the data updates, which he has said quite a bit, but he made a point to say it. He was asked whether or not the next cut will be 25 or 50 basis points, and he basically said he has no idea whether rates will even come down at the next meeting. So he's definitely avoiding committing at the party line to, we're going to keep lowering, it's a new era, we're going to lower interest rates. So he's definitely not saying that. He says, quote, there's nothing in the SEP, the Summary of Economic Projections, that suggests the committee is in a rush to get this done. Powell said in a press conference, quote, this process evolves over time. So definitely taking it slow, taking it as the data comes through, and not committing to a particular ongoing stance or ongoing plan of action, I guess, which is
Yeah.
probably smart because it means he'll get criticised less if he needs to do something that's unexpected.
Yeah. Make less predictions. No more transitory. We're in recalibration mode now.
Yeah, exactly.
We're done making long predictions about inflation moving in either direction. It's now recalibration.
Yeah, he's learned his lesson. But one of the questions, Hamish, and I think this is what you've got slated up to talk about next. I've seen quite a few YouTube videos over the past couple of weeks, and even just news reports of people saying that in this cycle where rates start to come down, a recession soon follows. Like
yes.
It's like a trigger. It's like not a trigger. It's like a what's the word I'm looking for? An indicator of an upcoming recession.
Yeah.
And you've done the digging on this, have you? Is that true? What can you tell us about that?
Yeah, so it's rather interesting because even though a rate cut is kind of a stimulative kind of action, if you look back at some of the recent US recessions, the first rate cut actually came before the recession period. So the big one was obviously the global financial crisis. If you just look at the chart of the Fed rate cuts and when the recession periods actually came, the same happened during the internet bubble, then the rate cut actually came before the recession. And so that's why you're going to see a bunch of articles kind of, as you said, talking about this as some kind of indicator. But that is really not the full picture. And I kind of want to go into it and kind of explore it a little bit, because even though that actually is true, that before the global financial crisis recession period actually began, there was a rate cut, and the same in the dot-com bubble. There's actually been 8 rate cut kind of cycles or periods since 1990. So even though a couple of them you have this kind of effect where the interest rate cut came and then a recession occurred, there's a lot of different reasons why the Fed actually cuts rates. There's different degrees to which they cut interest rates. Sometimes it's just a couple of months in a row. Sometimes it's over a 2-year period. Sometimes it's very dramatic and sharp, like we saw in 2007 or during 2020. So I think it's interesting, at least to me, to understand a little bit more context around what these rate cuts actually mean and the different types of kind of rate cuts that we've seen in the past. And so the first and kind of most common reason that the Fed cuts rates, and this is what you'll see a lot of people referring to, this idea that, a recession is coming and that sort of thing, is that the most common reason the Fed cuts rates is to react to an economic event or circumstance or a shock or something like that. And since 1990, out of the 8 rate cut cycles, there's been 4 of those rate cut cycles were reacting to an economic event. So that's 1990, 2001, 2007, and then, of course, 2020. And so in each of these circumstances, except for 2020, the rate cuts did come before the official recession period, but they were still in reaction to an economic event that was already kind of unraveling. It just hadn't pushed the US into recession. And I think that's really important to understand. So in 1990, for example, when the Fed started cutting rates, the US was not in a recession, but the world was already starting to learn about Iraq, which had invaded Kuwait, which is an OPEC country, and that had caused quite a significant oil price shock. So the price of oil in 1990, within a 6-month period, went from $17 a barrel to $39 a barrel. So even though the US wasn't in recession, and you could look at the graph and say, okay, well, they cut rates and then a recession came, the rate cuts were in reaction to the shock that had already happened. It's just that it hadn't kind of pushed its way into the GDP numbers yet. It hadn't pushed its way into the US actually falling into recession. And the same is actually true with all of these kind of large kind of recession periods that we've seen in the US. So in 2001, the Fed cut rates in January of 2001, and then a recession started in March. So again, it looks like, well, they cut rates and then a recession came a few months later. But already in January, when they were cutting, the internet bubble was already bursting. So the stock market actually peaked in 2000. The stock market was down 12%. There was a number of companies failing. People were starting to realize that a lot of these internet companies didn't produce any profit, or in some cases any revenue, and they had these huge valuations. And so again, even though a recession wasn't taking place at the time of the rate cuts, the Fed was still reacting to an economic shock. Same is true in 2007. So the Fed cut rates in September. Recession didn't start until December, a couple months later. But already in September of 2007, the housing bubble was already popping. And I think this is really important because a lot of people or a lot of articles are going to say, well, the Fed is cutting rates, so look at these past periods. A recession is going to come in the next few months. But the big difference in 2024 is that there isn't any large economic shock that the Fed is reacting to, right? So there's no AI bubble that has popped. There's no particular crisis that's going on right now that the Fed is actually responding to, which is kind of what we see in those examples. Instead, there's actually some other rate cut cycles since 1990 that are kind of a better match, I guess, to what we're seeing today. And interestingly, all of these, none of them resulted in a recession. That none of them had a recession that came shortly after. Essentially, in 2024, as you mentioned, the Fed is doing what's called a recalibration, which is basically, if you look at past FOMC meetings from previous rate cut cycles, he's basically rebranded what he used to call a mid-cycle adjustment. So the Fed, well, not him, previous Fed chairman, but this used to be called a mid-cycle adjustment. Now it's a recalibration, I guess. I guess that's the 2024 rebranding for you. That's the Gen.
They've got their marketing team on it. They've got their PR team on it.
Exactly. Yeah, it's the Gen Z branding. But essentially, there's been 3 of these kind of recalibration Fed rate cut periods since 1990. There was one in 1995, one in 2002, and there was one in 2019. So in 1995, the economy was doing pretty well. Inflation was only 3%. Unemployment was a little high, but it was fairly steady. And the stock market had basically gone flat for about a year, but it was kind of in the middle of this tech bubble starting to develop. So, given that economic conditions were pretty good, why did the Fed cut rates by 75 basis points? They did 50 basis points, and then I think it was 25 basis points, so kind of 2 months back to back. If we read the quote from the July 1995 FOMC meeting, this is what they say. As a result of the monetary tightening initiated in early 1994, inflationary pressures have receded enough to accommodate a modest adjustment in monetary conditions. And so that sounds quite a lot like at least what we're experiencing, or what Jerome Powell just said at the 2024 meeting. And so that was 1995. Of course, we know that the next recession wasn't for 6 years. So that's kind of one example. The next one was 2002. So this is different to the rate cuts that they did in 2001. So 2001 was in response to the internet bubble. But then in 2002, the 2001 recession was over. Inflation was just 2%. Unemployment rate was 5.7%. And the US wasn't in a recession. But again, they cut rates by 75 basis points. And in this case, the Fed was essentially responding to what they called a slightly weakening economy. So they were just a little worried that inflation was coming down too fast. They were actually worried that it might slip into deflation. So they just did a small cut to, kind of mid-cycle cut to boost the economy a little bit. And after those rate cuts, there wasn't a recession for 5 years until the global financial crisis.
Okay.
And so, we don't have a lot of examples. The only other example of this kind of mid-cycle adjustment was 2019. And of course, recession did come shortly after, but you couldn't in any way correlate that with the rate cuts that happened in 2019 because the 2020 recession was related to COVID. And so I'm pretty sure the Fed cutting rates didn't cause the spread of COVID-19. So there isn't a huge number of examples here, but I think it is important to note that historically, when the Fed cuts and it's not in response to an economic shock, it's just a little bit of weakness or that inflation pressures have eased. Historically, it actually hasn't there hasn't been a recession that's come shortly after.
Right.
And so
there you go.
That's the only other thing I would say on that is that's certainly not to say that definitely there's just going to be a 5-year bull market now or something like that, because an economic shock can happen at any time. And tomorrow, after we release this episode, there could be an economic shock. There could be an oil shock or something like that then causes the Fed to cut rates further, and then a recession comes, right? We don't know. But certainly people who are kind of saying, well, look at 2007, they cut rates 50 basis points and then a recession happened 2 months later. That narrative just it's not really supported in the different case studies we see over the past 35 years.
It's kind of like whether is it reactionary or is it just a normal part of the economic happenings at the time? I think you could even just draw the example actually of the pandemic versus now. Because when the pandemic first started, the Fed dropped rates to 0. But that was as a result, they did that very deliberately because of what had happened with the pandemic. Whereas this time, there's no resurgence of the pandemic. It's just, inflation's now cooled, we can adjust our policy.
Yeah.
So they are.
Exactly.
Yeah.
Yeah.
No, that's very interesting. Yeah, that answers the question too, because I've seen a lot of people talking about, you know what it means when the Fed first starts to cut rates? It means there's an impending recession. So that's actually really good data from all the however many times you just mentioned that it's actually not the case.
Yeah.
Interesting. And I'm guessing is that what you made your YouTube video on that's coming up?
Yeah, so if you want to see some nice graphs and that sort of thing about that, then check out the video. It'll definitely be out by the time this podcast goes out. But yes, so kind of just to summarize, I guess there's been 8 rate cut periods since 1990. 4 of them are essentially reacting to some kind of economic shock. And a recession quickly came after that. The only cycle I didn't mention was 1998, where they were even reacting to an economic shock, the Asia currency crisis, and there still wasn't a recession that came after. So even if there is an economic shock and they react to it, it doesn't necessarily mean that a recession will happen. And then the last 3 rate cuts were just mid-cycle adjustments, now rebranded as recalibrations. There you go.
Gen Z boss and a recalibration.
Yep.
All right. Shall we talk about something that's not to do with the Federal Reserve and interest rates for just a small part of this podcast?
Can we finally get some good Wi-Fi, especially on flights, on international flights?
Yes, we can, Hamish. Yes, we can. Because Starlink has partnered now with United Airlines, which is quite something. It says here, United Airlines announced on Friday that it struck a deal with SpaceX's satellite internet service Starlink to beam Wi-Fi down into its planes while they're in flight. Starlink already had a handful of airlines in its stable, but partnering with United is a big step forward towards cementing itself as a go-to internet provider for the transportation sector. SpaceX nearly doubled its backlog of Starlink in-flight Wi-Fi orders with last week's United Airlines deal, a company director said on Tuesday. Quote, very excited that we have about 2,500 aircraft under contract now, bringing what was effectively a startup to now what we think is a growing experience that's going to resonate with all the passengers and the airlines worldwide. Nick Galano, SpaceX Director of Starlink Aviation Sales and Partnerships, said during a panel at the World Space Business Week conference in Paris. So it's quite interesting. The satellite arm of Elon Musk's space company is pushing into the in-flight connectivity or IFC market. Last week, United said it will outfit more than 1,000 planes with Starlink and won't charge customers for the Wi-Fi. Wow. So that will be something. Yeah, I guess up until fairly recently, Starlink has just been targeting consumers on the ground. You know, you buy one of those Wi-Fi, those Starlink satellite terminal things, and you stick it, you know, point it to the sky, and you've got high-speed satellite internet. But now, I like this. I like that they're going to stick them on planes and stick them on boats. This is just fantastic. Because that's probably the times that I get really, really annoyed, when I'm on a plane and I don't have Wi-Fi, or when like I'm on a cruise ship, for example, going on a holiday and the internet is just trash.
Yeah, well, it is kind of crazy, right? Like that it's been, like 30 years of the internet, maybe not 30 years, maybe like 20, 25 years or so of like decent internet. Yeah. And on planes, it's still, you know, I mean, sometimes you get it, but a lot of the time you'll have to pay for it. Most of the time you'll have to pay quite a bit for it. And then on a lot of flights, it just won't. A lot of international flights, for example, it just wouldn't be there. Or it's like heavily limited like to messaging or something. It's kind of crazy that 2.5 decades after, you know, in this like internet age, it's only now that I guess maybe over the next couple of years, if this kind of works out, we'll have, just, free Wi-Fi on planes. That's really good. Will just be like a normal thing.
Well, the reason for that, obviously, because our Wi-Fi is based on the cell towers that are around. So it's very much a proximity. We have to be quite close to them. So, you know, when you're up in the sky, you don't get the reception. But the interesting thing is, to your point, as to why this is so crazy, that it hasn't been, you know, it's still 2024 and we're still struggling for Wi-Fi on airplanes. It's because satellite internet has actually been quite cost prohibitive before SpaceX came along. Because SpaceX has the competitive advantage that it has the launch capabilities itself. So they can just chuck a whole bunch of satellites on one of their rockets and shoot it up into space. Whereas before that, it would be a commercial partnership with a launch partner, which makes it makes the economics not work out as well. SpaceX definitely has the advantage in being able to do end-to-end, do it all themselves. And that's the reason now why I think they will become a clear front runner in satellite internet. But it's quite interesting. But there's a big trend now of boats and planes and all sorts getting Starlink because it's just really easy. It's very, very simple. And the internet, all of the reviews of Starlink that I've heard have been overwhelmingly positive for connectivity and internet speeds as well, which is really cool. Okay, what else have we got? The United mega deal was Starlink's largest IFC agreement yet. It will also push out United's existing quartet of Wi-Fi providers, Viasat, Panasonic, Thales, and GoGo. So they're out. They're out and Starlink is in. SpaceX has previously announced in-flight deals and has started service with Hawaiian Airlines, Qatar Airways, Japan's Zip Air, Latvia's Air Baltic, and a semi-private charter airline JSX. Okay, so they already had quite a few customers, actually. SpaceX has steadily expanded its Starlink network and product offerings since its debut in 2020. The company initially targeted consumers, but has expanded into other markets, including enterprise services such as aviation and maritime. Yes, that's what we were just talking about. There are currently about 6,400 Starlink satellites in orbit that connect more than 3 million customers in 100 countries, according to the company. So, pretty cool. Pretty cool. But that is just about all I have on the Starlink front as I read through the rest of the article. But with that said, that's enough. That's enough of non-macroeconomic news for the week.
Yes,
Hamish.
sorry about that, guys. We can now get back to what's really interesting.
Quick interlude.
No, but just before we move on from space, did you see the space walk that I think SpaceX live streamed last week or something like that? Yeah, that was pretty cool. I'd never.
Or was it like the first private spacewalk or something like that?
Right. Okay. Yeah, I've never seen any. I don't even know if they have live streamed anything like that before. At least like
that's the first time this has happened.
Yeah, so that was kind of interesting. I found it kind of annoying that they the timing of it was it just like they were over like the dark side of Earth for like most of it. It would have been really cool if for like the whole duration you could see the Earth in the background, because you could see the Earth obviously for the start of it, and then very quickly the orbit went into the darkness, so you didn't really see too much. But yeah, interesting.
That was very, very cool. That's what I'd want to do. If I went up into space, I'd want to be in my astronaut suit and be in space.
Yeah.
Be like, whoa, like outside the capsule, like living life on the edge. But anyway,
there you go.
Just hope your tether doesn't break.
Yeah, that would not be good. Just permanently in orbit.
Yep. All right, Hamish, tell me about some more macroeconomic news, my friend.
Yes, so I thought it'd be unfair if we didn't talk a little bit about Australia's economy, because as we've mentioned the last couple of times we've spoken about it, Australia's in a little bit of a unique position, and some of the recent data kind of confirms that. So the article says Australia's commodity-rich economy recorded its weakest growth momentum since the early 90s in the second quarter. Real GDP growth was just 0.2% quarter over quarter. So the real economic output adjusted for inflation, just 0.2% growth. And even growth year over year was just 1%, which is obviously very, very slow. Excluding the COVID-19 pandemic period, of course, the annual growth was the lowest since 1992. Which I believe, besides COVID, that 1990 recession was the last time Australia had a recession, because we didn't actually go into recession during the global financial crisis. And so this not only reflects kind of the slowest growth since that period, but that 1992 is kind of a meaningful year, because it was just at the end of the last recession Australia had, excluding COVID, of course, which was quite a different kind of recession.
Quite slow growth, Hamish. We're going to have to, that's it. Get your pickaxe, mate. We're heading back to the mines. Off we go. I thought you were dig up some iron ore to save the economy.
I thought you were going to say get your credit card out and start spending, but we can do the mines too. Sure.
Oh dear.
But that is interesting that you kind of bring that up, because household spending was one of the major reasons why there was a slowdown. And interestingly, while GDP growth year over year was 1%, that's for the whole economy. If we look at on a per capita basis, so on a kind of a per person basis, Australia's already in a recession, and we've been in a recession for quite a while. So GDP per capita, which excludes the fact that obviously our population is growing. It's growing at about 2.5%, 2.5% per year. So new people coming into the economy contributes to the overall growth. But on a per capita basis, GDP fell 0.4% from the previous quarter. So quarter over quarter, 0.4%, which is the sixth consecutive quarterly fall. So on a per person basis, Australia's already, the Australian economy has been shrinking, and it's really just population growth that's been keeping the economy, the overall economy moving forward.
Right.
And so in terms of what's kind of contributing to the slowdown, as I said, household spending was a major part of it. Household spending fell 0.2% in the quarter. And get this, on a per capita basis, so on a per person basis, spending fell 2% in the quarter, which is quite a significant downward move. In the other direction, slightly supporting the economic growth at the moment, government spending rose 1.4% quarter over quarter. That also played a kind of a considerable role. And so the concern for the RBA at the moment, the central bank, is quite a bit different to what the Fed in the US is facing. Because in our case, we have, in a similar case, I guess we have a slowing economy, but it's a little bit worse in Australia than it is in the US. But the difference is inflation in Australia is quite a bit worse. So I can't remember exactly what you mentioned. 2.2%, I think, is what the Fed said their inflation is. Australia is at 3.5% as of July, so it's slightly higher, slightly outside of the 2 to 3% kind of healthy range. It's not terrible, but it is kind of on the upper edge of that. So, it raises a little bit more of a difficult question, I think, for the RBA, which is, do you cut rates like the US is to boost economic growth, but kind of risk reigniting inflation that's already outside the healthy range? Or do you maintain rates to keep reducing inflation, get it into that range? But of course, that puts in more downward pressure, particularly on things like household spending, which is already declining a lot. And so,
hang on, we've just got a knock on the door. Oh, no, come in. Oh, it's Ray Dalio, Hamish. I think he heard you talking. What's that, Ray? Stag what? He's just saying stagflation, Hamish. I don't know what he's
stagflation.
Stagflation. We might be heading into a stagflation. All right, Ray. No, it's okay. No, you don't know. We don't need to talk to you about it. We understand.
Yeah.
No, I'll see you later. Yeah.
What's that? Five forces? Yeah. We know, Ray.
Five forces driving the economy. Yeah, that's so funny. In all of his interviews, he's always talking about these 5 key economic forces driving the economy. And me and Hamish have a bit of an inside joke that he just says this all the time.
Yeah.
And lo and behold, I looked into CNBC this morning. I sent Hamish a screenshot of what they deemed to be breaking news. And the screenshot was Ray Dalio talking about the 5 forces that are driving the economy or affecting the economy, which I found funny. He's only been saying it for 3 years, but it's still breaking news somehow.
Yeah. We love Ray Dalio. He's great, but when he does his kind of press, I don't know what you would call like interview tours or wherever he does CNBC and Bloomberg, he has his talking points and he doesn't stray.
He does.
And and so it's always so funny. You see the CNBC host try and ask a question that's just beyond what he's already said in the last 10 interviews, and he goes, "Well, let me slow you down. Let's start at the 5 forces." And they just can't get anything out of him. So one day we'll get something new from Ray Dalio.
Yeah.
But yes,
Where are
I think
you going on your ski vacation, Ray? I'm going to the 5 key forces. Like you could ask him anything, and he'd still say 5 key forces affecting the economy.
Yeah.
Anyway,
Exactly.
Sorry, I derailed that a little bit.
No,
Hamish.
but you're right. Ray Dalio probably would categorize the Australian concern as a stagflationary concern, a slowing economy with inflation that's still too high. It's not there at the moment, but that would be kind of the concern. The RBA governor, Michelle Bullock, said last week near-term rate cuts aren't being considered. So they're saying that they're not going to do near-term rate cuts. But financial markets have been pricing in a rate cut by the end of this year, while most economists expect the RBA will stay where they are with interest rates until early 2025. So there you go.
Right. There you go. Very interesting, Hamish. Good work, Australia. Woo. Go us. We're nailing it, aren't we?
Yep.
Yep. Well, there you go. And with that said, that's a cheery note to end on. It's a very cheery note.
We should have ended on free plane Wi-Fi.
Maybe. Or maybe we can end on Ray Dalio's 5 key forces. True, breaking news. Yeah. We'll talk about that one next week. All right, guys, that is it for today's podcast. Thanks very much for tuning in. We really appreciate it. Thanks, Hamish, for joining me as always.
No worries.
Any comments, feedback, questions, topics that you'd like us to talk about, drop us a comment. Please leave us a good review. If whatever platform you're on, if you can follow the podcast, if you can review the podcast, that stuff actually genuinely does help for podcasts. So we really appreciate it. We'd love a nice review.
How many stars should they leave? How many stars on the review? 5.
Well, 5 key stars. They should be leaving 5 stars.
Yeah, exactly.
And 5 stars, and we'll talk about the 5 key factors that Ray Dalio thinks is influencing the economy next week. That's the deal. Yeah. All right, we're going to bounce out of here, guys. Thanks very much for tuning in. We'll see you guys next week.
See you guys.